Webinar with me, Andrew Dawkins,
and myself, Rachel Blackhall.
Lovely having you with us, and hope you're all enjoying this beautiful summer weather, wherever you are.
Oh, I had the heating on at the weekend.
Ah. There you go, an insight into the life of Rachel. Well, we're delighted today. We're going to be doing a live link up with our friends at Marlborough, and we've been using Marlborough for a number of years now. So if we have a wee look at the agenda, which is coming up now. So what we'll be doing is in a second or two, we'll hand over to hopefully Richard and Nick over at Marlborough HQ. And then we'll have a break. We'll come back and we'll be saying what's been happening with us. We'll have a little bit of a view, if it's not already been covered, about the market trends and insights. And then we'll bring some exciting events that are coming up within the business. And finally, we'll take any questions and answers you might have. So as you all know by now, those that are listening live, if you want to type in any messages, comments you've got as we go along, and we're trying to get them included within the presentation. So without further ado,
we'll hand over to Richard and Nick.
Yeah, thank you. Thank you very much, and good morning, everybody. Firstly, on behalf of Marlborough, let me just say thank you to Andrew and Rachel and the team at A.R.D. Consultancy for giving us the opportunity to speak this morning. And again, just thank you everybody for their time. If I can just ask Andrew, who's going to control the slides, just to jump on to the next slide with the photos on it. That's super. Thank you. As we have a brief introduction, my name's Richard Telfer. I'm Business Development Manager here at Marlborough Group. That basically means my role is to work alongside independent financial advisor businesses like A.R.D. Consultancy and manage the relationship between themselves and ourselves. And through that relationship, we were invited and given the opportunity to join and present at the webinar. So I've taken the opportunity to bring on board my colleague, Nick Peters, who will be doing the majority of the presentation. I'll hand over to Nick in a moment. Nick, as you can see on screen there, is a customer's investment advisor, and Nick brings about a fantastic amount of experience and actually investing money, running as an investment manager, both working in Europe and global equity markets, and then more latterly with Fidelity International as a multi-asset portfolio manager, who are running multi-asset investments. So brings a lot of experience, and we've asked Nick to speak on some of the markets and some of the opportunities in some of our investment funds. And now, just moving on to the next slide, I'll just touch on a little bit on who Marlborough are. So we just jump on one slide there for me, please, Andrew. Great, thank you. So Marlborough it's an interesting point. We're slightly different to a lot of companies in our industry in that we are privately owned. And what's key and quite interesting is actually we were founded in 1985, started by an independent financial advisor, also called Andrew, a chap by the name of Andrew Staley. Andrew founded the business in 85, and the business has grown from being a financial advisory business through to an investment business over that period of time, where we built up fantastic expertise, and that's where we focus on. And as I say, Andrew is still the owner of our business. Now, just handing over to Nick, I'll ask Nick just to explore a little bit more about some of what we do and how we run investment funds. So over to yourself, Nick.
Okay, thank you very much, Richard, and morning, everybody. So if we turn to the next slide. So Marlborough is a slightly unusual fund management organisation. We have some of our own fund managers, so employed by Marlborough to manage some of our funds, but then we also partner up with a number of other organisations where they have expertise that we don't have readily available in-house. So for those partners, they provide the fund management capability, and then we obviously keep a close eye on performance and how they run the funds, and then market the funds as well. So you can see here a list of the partners. So some probably many of the listeners are well acquainted with, houses like Aberdeen, but then other houses like Canaccord, Genuity, you may not have heard of. They manage a number of our smaller company funds, and Boston Financial is a US house based in Boston, unsurprisingly, who manage a US fund. And I'll be talking more about the Boston and Canaccord capabilities a little later. So if we turn to the next slide, so what I plan to do is just give some highlights of market performance for this year and compare it to last year, and then pick out a couple of themes that our fund managers are talking a bit more about, and just sharing some views with yourselves. So what this chart shows is the returns. The black bars show the returns in 2023 across different asset classes, so equities, fixed interest, and what we call alternatives, and then a deep dive into some of the regions. So black is 2023, and the sort of orangey salmon color, the returns for year to date, so to the end of July. And you can see that within equities, they saw very good returns last year, and those trends have very much continued this year as well. Last year, led by the US. This year, the US leads again, but other markets like Japan and the UK, to a certain extent, are doing better in keeping up. And one of the key drivers for the US equities are those stocks that are called have been termed the Magnificent Seven. So these are the biggest companies in the US, quoted in the US, many of them tech companies that are really being boosted by earnings and anticipated earnings growth from artificial intelligence. Sorry, can you just pop back to the previous slide? Thanks very much. So artificial intelligence has sort of driven those returns, and that trend continues. Another thing to point out is China, how poor China was last year. You can see returns of minus 16%, only slightly positive this year. It's an open question about how Chinese policy, economic policy, can drive the economy and improve the economic picture there. And it seems that investors still need to be persuaded that actually the Chinese government have got their arms around the issues that they face there. But one thing the Chinese authorities are doing, along with another of other developing governments, is buying gold. And you can see on the right-hand side how gold performed reasonably well last year and is having a stellar year so far this year, because of demand, as a number of governments becoming a bit more wary about holding US treasuries and holding the dollar. They are looking at other safe havens, and gold is an obvious one. And you throw that in the mix with what we're seeing in the Middle East, and you can understand why gold is performing so well as a safe asset at the moment. And then lastly on this slide, under fixed interest, you can see we've got government bonds and corporate bonds and high yield. And some may be slightly disappointed by that performance in bonds, but actually I'd argue they're doing what they should be doing. Fixed interest is considered a defensive asset class. So when everything in the garden is rosy and things are going well and equities are performing well, then the more defensive areas like fixed income are ignored. It's when things turn sour and equities perform less well, then the anticipation is that fixed income should protect capital as a defensive asset. So right now, perhaps, when people are so positive about general economic growth and interest rates are coming down, then investors are willing to take a bit more risk. Risky assets like equities perform well, and defensive assets less well. So I would say that actually fixed income is doing its job now. And if we see a period when equities perform less well, then we should still continue to see positive returns from fixed income. Okay, so if we turn to the next slide, so just a deep dive on a few areas. So obviously got the US election coming up on November 5th. At the moment, it's too close to call between Trump and Harris. Personally, I suspect the head-to-head debate on the 10th of September will go a long way to making up people's minds. So I think that's going to be very interesting viewing. But what the point of this slide is actually to show that despite all the media noise and hand-wringing about policies, in terms of equity market returns, it actually doesn't matter so much whether we have a Republican president or a Democrat president. So these numbers go all the way back to 1950. And over the life of the Democratic president or the Republican president, you can see that the returns have been pretty impressive, whoever's leading the US and whoever's in control of Congress, whether that's Democrats, Republicans, or actually the Congress is split as well. And in fact, I was actually surprised to see that if there's a split in the Congress, so one party runs the House of Representatives and the other house runs the Senate, then the returns are best of all, kind of implying that politics takes a back seat and actually companies are allowed to do what they do best and look to grow earnings. So I think the takeaway here is enjoy all the media coverage, but actually don't worry too much about the returns from the US equities, whoever's in charge on November the 6th. And then on the next slide, I mentioned earlier about those Magnificent Seven. And what we show here is the earnings growth from, so the Magnificent Seven, Microsoft, Nvidia, Amazon, Google, Meta, Tesla, and Apple. And I mentioned, but these five that we show here are the ones that are most exposed to that artificial intelligence theme that I mentioned earlier. So these are gigantic companies, and for them in 2023 to grow earnings by 57% is amazing. And then in the red bars, we've shown the earnings growth from the median company, so the average company in the S&P 500, which is the broad US index. So in 2023, pretty pitiful for the rest of the S&P, whilst the big five sort of forge ahead in earnings growth terms, but also forge ahead in terms of share price performance. And that's what's really driven the S&P in recent months and quarters. But what's interesting is if you look out at forecast earnings, so out to 2026, so the big five, and this would be the same for the other two companies as well to make up the Magnificent Seven, are forecast to grow earnings by 13%. And it's a bit more even Steven with the other companies as well. So 9% for the average company in the S&P 500. So at some point, what you'll see within US equities is people will stop focusing on the Magnificent Seven and actually look beyond those seven companies and look at the prospects for other companies quoted in the US. And we've had a kind of taster of that in the last 6 to 8 weeks. When one or two of the big seven have produced earnings that haven't been quite as good as people were anticipating, and let's face it, when you're $1 trillion company, the chances of generating earnings growth of 50-odd% every year is very slim. The law of large numbers says that that's very difficult to do on a regular basis. So we think that that generally speaking, investors are going to start looking more pessimistically, perhaps, in terms of the earnings growth of these big companies, and looking at other companies in the US where valuations are a lot cheaper, and prospects are perhaps not as good as the Magnificent Seven, but still pretty good. And if you turn to the next slide, so this is our US manager. As I said, so Brad Weaver runs the Marlborough US Focus Fund. He actually works for our partner Boston Financial, and he tends to look at larger companies, but has a very strong sort of valuation ethos as well. So he looks for high quality companies that have strong market positions in their industries. Performance over the long term has been excellent. He's struggled more recently as the Magnificent Seven have sort of dominated returns, but we're very excited about this fund when interest in US equities broadens out. And then on the next slide, another theme that I think is worth highlighting is the performance of smaller companies. Again, and this is smaller companies not only in the US, but other regions like Europe, UK as well. And as investors generally have looked at technology and artificial intelligence, and also worried about the impact of high interest rates, then we've seen smaller companies generally struggle. Now, academic research suggests that over the long term, smaller companies do better than larger companies. Basically, smaller companies are more risky just because of their size and their position within an industry, and they are looking to grow quickly, and there are lots of risks around that growth. But if it comes good, then you do see significant rewards for taking the risk of investing in smaller companies. And what this slide shows is that actually investors tend to look more closely at smaller companies once interest rates start coming down. Now, obviously in the UK, we've seen interest rate cuts already starting. And in the US, it's pretty nailed on that the Fed are going to cut rates for the first time in September. But then there should be, assuming that the inflation remains under control, there should be a steady drumbeat of interest rate cuts going forward from the US, UK, and for Europe. And that is a great backdrop for smaller companies. And you can see here, basically over each time period that we show, so the first 3 months after the first rate cut, 6 months and 12 months, smaller companies do better. And one of the main reasons being that actually the environment, in terms of, so a lot of smaller companies tend to rely on debt to help grow the business. And if interest rates are coming down, that's obviously better for smaller companies from their financial perspective. And assuming that economic growth continues to at a reasonable clip, then smaller companies should benefit from that. And if you turn to the next slide, we've included one of our smaller company fund managers. So David Walton is employed by Canaccord, who I mentioned is one of our key partners. And we've had a very long relationship with Canaccord. David's been managing this European, it's called European Special Situations, but it's basically exposed to smaller companies. And he's been managing the fund for over 10 years now. And has about 80 holdings in the fund. And a bit like Brad, in that he tends to prefer market leaders or companies that are growing in industries that have got strong growth dynamics, and performance has been excellent. And we do think we're very excited about our smaller companies funds. We have this one where David is managing European companies. We have UK funds that invest primarily in the UK. We also have a global small cap fund, and we have high hopes for all those funds going forward. That's it. I've got some appendices which just go into a bit more detail about the performance, but I the two funds that I've mentioned, but I won't go into that in detail. Andrew, Rachel, Daniel, I'll hand back to you. But as I say, the two themes that I think are very interesting is life after the Magnificent Seven, and also the performance of smaller companies going forward. Back to you.
Can I just step in for 1 second, Andrew? Sorry, Nick, I was just going to ask one question. Clearly a loaded question, the fact I'm asking for it. When we say smaller companies, just for the context, what sort of scale, what sort of size are we talking? Just to put context around that.
Yeah, so for the European fund, anything less than 700 or 800 million euros is considered smaller companies. But if they go above that, David is quite, will tend to hold on to them. So he likes to run his winners as well. But for an initial position, it's probably 700 or 800 is the max.
Right. And so just for context, when we talked about the mega caps, we're all aware of Apple and how big they are. But when we say small companies, just the context. So thank you. Thanks very much. I'll hand back to Andrew and Rachel now. So thank you again for the opportunity to speak this morning.
Thank you for joining us.
Lovely. Thank you very much. It's great to have some expert opinion there. Thank you very much, Nick, and thanks, Richard. I'm sure we'll be catching up with both of you really soon when we do our next portfolio review. But thank you for taking the time to share those interesting thoughts with us.
You're welcome.
Thank you very much indeed. Cheerio. Bye-bye.
Bye-bye.
Thank you. Bye-bye.
There we are. Well,
Okay.
I think it's one of the things that Rachel and I enjoy about this job is being able to speak to some of the investment managers and funds that we deal with here in the hub.
Yeah, exactly. We really like to get to the nitty-gritty about what they invest in and why, and the methodology and why they choose these companies or why they exclude certain companies. There's a lot that really goes into it, and it's not just about performance.
Yes, that's right. It's nice as well to visit the city now and again and get a feel for what's going on. Because here in Falkirk, we don't get many bigwigs this way, do we? Well, anyway, so moving on. What's been happening with us really?
Yeah, it's been certainly a busy start to the year, which is great, and thankfully, I'm sure you're going to touch on, Andrew, the investment markets are starting to settle out a bit after last year being quite a turbulent year. Things are getting more to the norm, as we would say.
They would say. Indeed, yes. So I think really the good news is that really there has been no particular sort of major changes so far in the year, but perhaps that may all change a wee bit later. Looking at the markets then, what they've been doing, well, if we look over the last year, then it's been a very positive time for many of the funds that we invest in or recommend. And I think this has been driven by the fact that towards the end of last year, we could see inflation was reducing. And at long last, the dopey idiots in charge of the world central banks started to reduce or say, well, actually, we're not going to put up interest rates anymore. And indeed, over here in Euroland, she put a sort of a reduction of 0.25, and then the Bank of England did the same a couple of months ago as well. And we're all expecting that in the next week or so, the Federal Reserve, the world's biggest central bank, will also do likewise and start reducing rates. So that's led to a sort of position then that investment funds are a lot more confident about the long-term stability within the market, because as we all know, nobody likes the thought of, well, what are things going to be doing? Having to second guess. And that's what we were doing throughout 2022 and 2023, wondering how high interest rates were going to go and high inflation was going to go. Well, inflation returning back to what these experts want, close to 2%, has been good. And then the money markets getting the hold on rate increases again. It means that money flows back into the market. So short term, there isn't really much we can do. Long term, that's where investing makes a big difference to people's wealth. Short term, we can't control what's going to happen in the money markets. Long term, though, we pick those funds that we think are designed to outperform the others. So on the whole, it's been a very, very good last 1 year with positive returns in most of the markets. Some of the smaller funds, such as ethical, sustainable funds, are still having it bad because generally they are the last ones to recover. Once people can see that they've made as much money as they possibly can with the traditional big companies, then they start looking at alternate types of investments, and that's when the sustainable ethical funds start to fire on all cylinders. Now, what we've been doing since the, 2020, the onset of COVID-19, was to provide a monthly market update of our ramblings and views on what's been happening and various other things and fact of the month. What we've decided to do is a radical change from this.
Yes, we're thinking about moving this to a quarterly update. On the back of what Andrew was just explaining there, as markets are starting to settle, we want to be able to bring you information that's actually going to be valuable, rather than each month saying, we think this will happen, we think this will happen, or this is supposed to happen, or if there's really not much been happening. So we feel that moving it to quarterly will be able to bring you a bit of a more rounded update of what has changed and how that affects anything in the world of investments and the A.R.D portfolios as well. But obviously, if there's anything substantially that changes in between times, we'll certainly do ad hoc recordings to bring you some updates if we think it's worthwhile.
We certainly will. Then moving on then, so
what's been happening?
Well, the last update we did, we were just about to go into the results from the general election, which surprised, I think, absolutely nobody in terms of what was predicted for once. So with Labour taking office, the city, I think it was the first time in the 160 years I've been doing this, where actually a lot of people, well, those people that we spoke to would give us an opinion, were actually saying that they would welcome a Labour government, which is fairly unheard of. I can't remember the last time anybody said that to me. But anyway, so they were really saying that on the back of the number of changes that have been forced, I think, really on the previous government with COVID and with Brexit. So they were hoping that the Labour Party would get something of a substantial majority so that we could have a clear course for what was going to be a very turbulent period going over the next few years because of the level of debt that the country faces, with record amounts of borrowing from the effects of COVID-19, but also prior to that with the effects of the financial crisis of 2008, which is still sort of accounting for a big pile of debt. So it's the first time really that we're seeing the Labour government coming in and the markets actually went up a percentage point or two, and then they've settled back down. And what happened in the rest of Europe with the unsuspected election in France gave the markets a little bit of worry, and said, well, at least UK has a solid government for the next 5 years. So therefore, let's look at the UK again. So what we're actually seeing now is that more money is now coming into the UK than we've had for a number of years. Has it had any effect? Well, long term, it might do, because one of the big difficulties, as I've just discussed, is the amount of debt that's on the books. And you've got two ways of addressing this. One is to increase tax revenue, and that's quite simply putting up tax rates or freezing allowances and such like. And in the short term, yes, that will bring in extra money. But long term, people then get a bit upset about this and look for ways to try and avoid it or pay less tax. So things like, can you do a cash in hand job and we'll forget about the VAT and those sort of things. So it actually disincentivizes, where the second option you could consider is actually quite a left-wing thing here, but reduce taxes. So if you reduce taxes, short term, it brings in less money, but longer term, it incentivizes people that if you know you're going to work an extra few hours and you're going to see more of your pay in your pocket rather than going on taxes, well, you might say, yeah, I'll tell you what, I'll do some of that. And companies, they may sort of expand as well if they can say, well, we're going to keep more of the profit we make here in the UK. That's not a bad thing either. But it takes some convincing that does actually work. I think we have a question.
Yes, we do. So on this topic of Labour, we've had a question in from Peter. He's saying, how worried should we be of Labour's attack on pensions? What's your thoughts?
Well, the Labour Party haven't really said a great deal at the moment about pensions. What we'd all hope for is that really there's no change in the pension rules, because one of the things over the last so many years is that with each change in pension rules and regulations, it actually does nothing but put people off pensions, because they go, oh my word, this is so blooming complicated. I tell you what, I'll do something completely different. So you'd like to think that perhaps they will keep the rules the same, but if they are looking at things, then one of the items that currently favours pensions is the fact that with a lot of pensions, in the event of somebody's death, the funds within the pension can be paid free of inheritance tax. And some people are saying that that may change, that then the funds within a pension might be subject to that tax, which would have major implications for those people with inheritance tax issues. The other thing that was talked about just before the election was getting rid of the tax-free cash amount, but I think that would be just a step too far, and indeed the Keir Starmer then pushed back later in the day when he originally said everything's under consideration, to say no, we're not actually going to change anything regarding tax-free cash, because again, it's one of the reasons why people take pensions out, is to look forward to that lovely pot of money coming their way without the government putting its mitts on and trying to claim some of it back. So I think that will be quite a tricky thing to do. The other thing is that they may consider is reducing the higher rate and additional rate tax relief on people paying contributions into pensions. Challenge with that is it's going to take a huge amount of effort and work to actually amend the tax rules, because of the way that tax is collected in the UK. So there's various things that they may look to do. Reintroduce the lifetime allowance so that people are limited to how much they put into a pension before it gets taxed. That may be one of the things, because that was changed 2 or 3 years ago to get rid of the lifetime allowance. They may change the amount you can pay in over the course of a year into a pension, but really we don't know. But just at the moment, it's sort of stay tuned to the budget, which will be coming up in October.
Moving on. Yes, we wanted to touch on the rebalance. So as we spoke about before, we'll regularly monitor the portfolios that we run, the A.R.D model portfolios. And normally once or twice a year, we'll really sit down and take a look under the bonnet and look at each of the funds and how they're performing, how they compare to others in the marketplace. So that is something that we are going to be doing in the next couple of months. What we are proposing this time is, rather than en masse making this bulk change, that we will do it on an individual basis, case by case at review. There's a number of reasons for this, and probably one of the big ones are, as Andrew was talking about, the tax changes. So the capital gains tax allowance has reduced quite drastically from previous years. So it makes this task of rebalancing and changing funds a lot more complex. So we want to make it a lot more personalised and tailored to each individual. So just to make you aware that we certainly will be looking at the portfolios, and we'll be contacting you individually to discuss this and also make these calculations before we implement any changes to your own individual accounts.
I think with the rebalance as well, we, as you know, clients that have been with us a good number of years, we don't make hundreds of changes each year. We just do the odd one or two. So I don't think many people would disadvantage if you find you're towards the end of the progress report, of those people towards the beginning of it. So it's just a question of we make changes as the rules change. Our advice and the way we do things changes as well. So it's all in your best interest. We feel. Now on to lighter subjects. Over to our good colleague here, Daniel.
Morning, everyone. Hopefully you can hear me loud and clear. I do have a louder voice than my friends here, Andrew and Rachel. Hopefully I'm not deafening you. I've been told many a time. But yes, so we've got a few events that are lined up through the end of this year. So as most of you will probably know, we do invest a lot in the community. And one of the events that was quite well received last year was the Linlithgow Roundtable Charity Beer Festival.
Mind you, I think those people who were there last time probably can't remember much about it.
Neither can I, Andrew. I'm trying to look back on my notes to see what exactly happened. It was a fun morning though. I remember the morning. I don't remember the evening.
Wasn't it?
I can't remember. It worked really well, but it was very successful, and the event actually reached full capacity. And therefore, this year they're moving it to a larger venue just next door at, I do like saying this, Borough Halls. So there's more space there. They're expecting.
So good they named it twice.
Yeah, they did. They're expecting more attendees, and for all of you beer fans, even more a wider selection of beers for everyone.
And cider as well. I think
There is cider and prosecco too.
Oh,
If you fancy that.
no, not really.
But the big thing is that they're also going to be introducing live music. So that should be fun. 7 o'clock after starting at 1. Should be fantastic. So we'll be there, and we're going to be the major sponsors. So once again, we'll be sponsoring the pint glasses that everyone receives when they walk in. And the good news is that we'll be hosting a similar event to what we did last year. So details will be shared soon. So please keep an eye out for that. And availability will be limited, and it'll be on a first come, first served basis. Is that correct, Andrew?
I believe so.
There we go. Lovely. So keep an eye out if you do want to partake in that and taste a few beers. The next, moving swiftly along to Larbert High School, from beers to Larbert High School.
Although there was alcohol involved in this last year as well.
It was, yes. So the Larbert High Appreciation Night, which we held last year, again, very successful to those that attended. We got some very positive feedback, and fortunately, we're going to be doing the same again this year, hopefully. So be arranging to meet up with our friends there. We are going to be supporting Larbert High School and the School of Hospitality, as well as the School of Dance. So we'll be supplying the School of Hospitality with aprons, School of Dance with jackets. Try not to get that the wrong way around because it wouldn't work. So,
Interesting.
Well, it would be. So we are going to be planning another event. Again, similar to what we did before. Hopefully the School of Hospitality will be putting on a lovely spread for everybody. There'll be alcohol there, so be prepared.
Do you think that's an
I
incentive?
don't think they knew that last time, did they?
The kids are the adults.
For the adults, for those attending from A.R.D. So I know a few people are a little, didn't realise. So don't drive.
One of the things is we'd ask those lovely people who came last time who walked off with our hard purchased bottle openers to please bring them back. We know who you are.
Yes, we had 10 and we have 1 left, don't we, Andrew?
We do.
And it was quite a trying morning to try and find those. I remember that clearly. More so than the beer festival. But so that's all coming up. So once again, similar to the beer festival, we'll be sending out communications. So please be aware of that and respond if you'd like to attend. First come, first served basis once again. And finally, from me, from the Aussie in the house, the A.R.D. Consultancy website. So if you haven't had a chance, pop on there. It's been revamped, renewed. So we've been working pretty hard behind the scenes just to get give it a bit of a more of a fresh and modern look, but also to make it a bit more personable. So there's a lot of Andrew running about, and also Lexi. If you don't know who Lexi is, then I feel you should go on and have a look, and just go onto the Contact Us page just now, and there will be a bio coming up very shortly. But it's a new member of staff, isn't it?
It is indeed, yes.
So yes. So feel free to pop on there, have a look around, and we always appreciate any feedback regarding that. And if there's any things that we can maybe tweak, then this is probably the time to do it. It went live yesterday, just last night. So please do feel free to have a look and send through any feedback you may have.
Yeah, lovely. Thank you very much for that, Daniel, and also for your hard work on the website, because we know you've been working very well into the late or the wee hours of the morning to get that sorted out for us. So thank you from us to you. Lovely. Well, that's the end of another webinar. We would hope you've enjoyed it. Full of technical stuff and market insight at the beginning, and then a little bit of nonsense from us up there at the end of it. So we hope that mix is good for you. But as always, please do send in your suggestions for future webinars. We'd love to hear from you, and anything, in fact, that you want included. Any suggestions?
From us?
Yeah.
No.
Rachel? Okay.
Rachel's there.
Yeah. That's fine. That's fine. You're putting on the spot, nice and live. And for those of you who are wondering, yes, Rachel was wearing a black jumper. She wasn't sort of
camouflaged.
No, she was a floating head. There's a few people that we've had a few comments there saying what's happened to Rachel's body. It's still here, so we haven't cut her head off and made her into a mannequin yet. Anyway, stay tuned for the next one. Thank you very much for sharing your time with us, and as always, we wish you a lovely week ahead, and let's hope we get a bit of sunshine and dry weather. That would be nice, wouldn't it, to end summer with?
Yes.
Correct.
Bye,
Thank
everyone.
you very much. Bye-bye.